Most investors are watching the wrong signals. While everyone's focused on the spot price bouncing around, there's an indicator that's been quietly flashing red for months. And when I show you what it's predicting, you're going to understand why some of the smartest money in the world is positioning for a move that could take silver past $100 an ounce. Let me be clear up front. I'm not talking about some obscure technical pattern or a guru's prediction. I'm talking about hard data from the physical market that's creating a mathematical inevitability. The kind of setup that doesn't care about your opinion or mine. It just is. So what is this hidden indicator? It's the gold to silver ratio combined with something most people never look at. The divergence between paper silver and physical silver availability. And right now, that divergence is screaming louder than it has in decades. Here's what you need to understand. Silver just hit record highs, nearly doubling in price over the past year. We're talking about moves from the low 30s to touching $60 an ounce. That's an almost 90% gain. But here's the thing that should make your ears perk up. Despite this massive rally, the gold to silver ratio is still historically elevated. Think about that for a second. Gold and silver have moved together for thousands of years. They're monetary metals, store of value assets, safe havens. When one moves, the other typically follows. But the ratio between them tells you which one is undervalued relative to the other. And right now, even after silver's explosive run, that ratio is telling us something profound. The gold to silver ratio has been breaking down from levels we haven't seen sustained since the financial crisis. We're watching a 14-year floor collapse in real time. When this ratio was last at these levels and started breaking down, silver went from $15 to nearly $50 in less than a year. That was back in the 2010-2011 run. But the setup now is actually more compelling, and I'll show you why. Let's talk about what's happening in the physical market, because this is where the story gets really interesting. COMEX inventories, the registered silver available for delivery in New York, have been in a structural decline. We're not talking about a temporary dip. We're talking about a multi-year trend of metal leaving the vaults. At the same time, London vaults, which handle the bulk of institutional silver trading, are seeing similar patterns. Now, you might be thinking, okay, inventories are declining. So what? Here's the so what. Silver isn't just a monetary metal. It's an industrial metal. And the industrial demand is exploding in ways that most people don't fully appreciate yet. Solar panels require silver, every single one. And global solar installations are accelerating at a pace that's outstripping even the most optimistic forecasts from just a few years ago. Electric vehicles use significantly more silver than traditional cars. The electrification of everything, from vehicles to power grids to data centers, is creating structural demand that didn't exist a decade ago. But here's where it gets really interesting. Silver supply is relatively inelastic. You can't just turn on a switch and produce more silver. Most silver comes as a byproduct of other mining operations, primarily copper, lead, and zinc. So when industrial demand surges, the supply side can't respond quickly. It takes years to bring new mines online, and even then you're dependent on the economics of the primary metal being mined. This creates a squeeze dynamic, and we're starting to see the early signs of it playing out in the physical market. Premiums on physical silver, the amount you pay above the spot price to actually get metal in your hand, have been elevated for months. Delivery delays are becoming more common. Dealers are reporting allocation issues. These are the kinds of signals that precede major price dislocations. Let me paint you a picture of what happened the last time we saw a setup like this. It was the late 70s, early 80s. Silver went from around $5 an ounce to $50 in a matter of months. Now that was driven by the Hunt brothers trying to corner the market, which is a different dynamic. But the underlying conditions were similar. Tight physical supply, strong demand, and a growing awareness that paper claims on silver far exceeded the physical metal available. Fast forward to today, and we have something even more interesting happening. Central banks around the world are diversifying away from dollar-denominated assets. We're watching the early stages of a global monetary reset, whether people want to call it that or not. Countries are settling trade in their own currencies. The BRICS nations are exploring alternatives to the dollar system. And when you're a central bank looking to diversify, you buy gold. But you also buy silver, because silver is gold's little brother with industrial utility. The data shows central bank gold purchases at record levels. They're accumulating at a pace we haven't seen in decades. And while silver doesn't get the same headlines, the smart money understands that silver offers leverage to the same thesis with the added benefit of industrial demand growth. Now let's talk about the paper market because this is where things get really fascinating. The silver futures market on COMEX operates on a fractional reserve basis. There are far more paper claims on silver than there is physical silver in the vaults. This works fine as long as most people are content to trade paper and never take delivery. But what happens when that changes? We saw a preview of this dynamic during the silver squeeze movement. Retail investors coordinated to buy physical silver and silver ETFs, trying to force delivery and expose the paper market's leverage. The price spiked, premiums exploded, and the system showed cracks. That movement eventually faded, but it revealed something important. The physical market is much tighter than the paper market suggests. Here's what most people miss. The paper market sets the price through futures trading, but the physical market determines what's actually available. And when those two markets diverge significantly, something has to give. Either the paper price rises to reflect physical scarcity, or the paper market breaks because people lose confidence in paper claims and demand physical delivery. Right now, we're seeing signs of both. The price has been rising, but physical premiums remain elevated, suggesting the paper price still hasn't fully caught up to physical reality, and institutional players are starting to notice. ETF inflows have been strong. Institutional positioning in silver futures has shifted. The smart money is accumulating. Let me give you some specific numbers to make this concrete. Silver hit all-time highs near $60 recently. That's impressive. But when you adjust for inflation, the real all-time high from 1980 would be well over $150 in today's money. Even the 2011 high of $50 would be around $70 adjusted for inflation. So despite the recent rally, silver is still historically cheap in real terms. But here's the kicker. The gold-to-silver ratio, even after silver's run, is still suggesting silver has significant room to run just to reach historical norms. Throughout most of history, that ratio has averaged somewhere between 15 to 1 and 50 to 1. We've been in an extended period where it's been much higher, sometimes touching 80 or 90 to 1. As that ratio normalizes and gold continues its own bull market, the math on silver becomes explosive. Let's do some quick calculations. If gold goes to $3,000 an ounce, which many analysts see as conservative given the macro environment, and the gold-to-silver ratio normalizes to even 60 to 1, that puts silver at $50. But if the ratio goes to 40 to 1, which is still above the historical average, you're looking at $75 silver. And if we see a real squeeze and the ratio compresses to 25 to 1, like we saw briefly in 2011, you're talking about $120 silver. Now, I'm not saying any of this happens overnight. Markets don't move in straight lines, but the setup is there, the fundamentals are there, the technical picture is there, and most importantly, the physical market dynamics are there. Here's something else to consider. The silver market is relatively small compared to other commodity markets. The entire above-ground silver supply that's available for investment is worth maybe $50 billion. That's nothing in the context of global capital markets. If even a small percentage of institutional money decides to allocate to silver, the price impact would be enormous. We're already seeing this play out in small ways. Silver ETFs have seen significant inflows. Mining stocks are starting to outperform. Retail demand remains strong. But the real move happens when institutional money comes in size, and the conditions for that are aligning. Think about the macro environment we're in. Inflation concerns aren't going away. Central banks are trapped between fighting inflation and supporting economic growth. Government debt levels are at all-time highs. Geopolitical tensions are rising. These are exactly the conditions that drive investors toward hard assets. And within hard assets, silver offers something unique. It's a monetary metal, like gold, so it benefits from safe haven demand. But it's also an industrial metal with growing demand from secular trends like electrification and renewable energy. That dual nature gives silver a floor from industrial demand and upside from monetary demand. Let me tell you about something that's happening right now that most people aren't paying attention to. The solar industry is projecting installations that will require more silver than current mining production can supply. We're talking about a structural deficit in the making. And unlike other commodities where high prices can destroy demand, silver in solar panels is such a small part of the total cost that even significantly higher silver prices won't slow installations. The same dynamic is playing out in electric vehicles. The amount of silver in an EV is roughly double what's in a traditional car, and global EV adoption is accelerating. China is leading the way, but Europe and North America are following. This isn't a maybe. This is happening right now, and it's creating demand that didn't exist 5 years ago. Now here's where the hidden indicator really comes into play. When you combine the gold-to-silver ratio breakdown with the physical market tightness and the industrial demand growth, you get a mathematical setup that points to much higher prices. It's not about predicting the future. It's about recognizing when the odds are heavily skewed in one direction. The paper market can suppress prices for a while through futures selling and derivatives, but eventually, physical reality asserts itself. And when it does, the moves can be violent. We saw this in 2020 when silver went from $15 to nearly $30 in a matter of months. We saw it in 2011 when silver went from $20 to $50. And we're seeing the early stages of it now. Quick aside here, because this is relevant if you're thinking about how to position for this. If you're sitting on significant retirement savings, 6 figures or more, there are ways to get exposure to physical precious metals within tax-advantaged accounts. I put together a free guide on how gold IRAs work, covering the mechanics of getting physical metal into retirement accounts without triggering tax events. It's in the description if that's relevant to your situation. Worth understanding the options available. But back to the indicator and what it's telling us. The breakdown in the gold-to-silver ratio isn't just a technical signal. It's a reflection of changing market dynamics. When this ratio starts to compress, it's telling you that silver is being revalued relative to gold. And given where we're starting from, that revaluation has a long way to run. Here's what makes this particularly compelling right now. We're not early to this move. Silver has already rallied significantly. But we're also not late. The physical market indicators suggest we're still in the early innings of a much larger move. The ratio breakdown is confirming what the physical market has been signaling for months. Think about the psychology of markets for a second. Most investors chase performance. They buy after something has already moved. Silver has moved enough to get on people's radar, but not so much that it feels like you've missed it. That's actually the sweet spot for a sustained bull market. You want to see confirmation that the move is real, but you also want room to run. And the room to run here is substantial. Even if we just get back to the inflation-adjusted 2011 high, we're talking about another 20 to 30% upside from current levels. But if we see a real squeeze, if the physical market dynamics force a repricing of paper silver, if industrial demand continues to grow while supply remains constrained, the upside is much larger. Let me give you a framework for thinking about this. In bull markets for commodities, prices typically overshoot fair value. They don't just go to where they should be based on fundamentals. They go beyond that because of momentum, speculation, and fear of missing out. We saw this in oil in 2008. We saw it in copper during the China boom. We saw it in silver itself in 2011. The question isn't whether silver will overshoot. The question is how far. And the answer to that depends on how severe the physical shortage becomes and how much capital flows into the space. But based on historical precedent and the current setup, $100 silver isn't just possible. It's actually a reasonable target if this plays out the way the indicators suggest. Now, I want to be clear about something. I'm not telling you to bet the farm on silver. I'm not telling you to go all in on mining stocks or futures contracts. What I'm telling you is that the risk-reward setup in silver right now is as compelling as it's been in years. The hidden indicator, this combination of ratio breakdown and physical market tightness, is flashing a signal that historically has preceded major moves. Here's what the smart money is doing. They're accumulating physical metal. They're buying quality mining stocks. They're positioning for a move that could take years to fully play out, but has already started. They're not trying to time the exact bottom or catch every wiggle. They're recognizing a structural opportunity and positioning accordingly. The beauty of a setup like this is that you don't need to be right about the exact timing. You just need to be right about the direction. And when you have physical market fundamentals supporting higher prices, industrial demand growing, monetary demand increasing, and a technical indicator confirming the move, the direction becomes pretty clear. Let me tell you what happens if this thesis is wrong. If industrial demand doesn't grow as expected, if new supply comes online faster than anticipated, if the paper market maintains control and prevents physical scarcity from driving prices, then silver probably trades sideways or pulls back from current levels. You might lose some money if you're positioned for higher prices. But the downside is relatively limited because industrial demand provides a floor. Now let me tell you what happens if this thesis is right. If the physical shortage intensifies, if the gold-to-silver ratio continues to compress, if institutional money starts flowing into the space, if any of the major silver ETFs face delivery issues that expose the paper market's leverage, then we're talking about a move that could be historic. We're talking about silver potentially doubling or tripling from current levels. We're talking about mining stocks that could go up 5 or 10 times. We're talking about a generational opportunity in a market that most people are still ignoring. The risk-reward asymmetry is what makes this compelling. The downside is probably 20 to 30% if everything goes wrong. The upside is potentially several 100% if things go right. And the indicators suggest the odds favor the upside scenario. Here's something else to consider. Silver has a history of explosive moves followed by long consolidations. We saw a massive run in the 70s, then a 20-year bear market. We saw another run in the 2000s peaking in 2011, then a decade-long consolidation. If we're at the start of another major bull market, and the indicators suggest we might be, then we're talking about a move that could last years, not months. The gold-to-silver ratio breakdown is telling us that silver is being revalued. The physical market tightness is telling us that paper prices haven't caught up to physical reality. The industrial demand growth is telling us that structural deficits are coming. And the macro environment is telling us that investors are going to increasingly seek hard assets as a hedge against monetary instability. When you put all of that together, you get a picture of a market that's setting up for a significant move higher. The hidden indicator isn't really hidden. It's just that most people aren't looking at it. They're focused on daily price action, on what some analysts said on TV, on short-term noise. But the real signal is in the data, in the physical market dynamics, in the ratio breakdown that's been quietly unfolding for months. $100 silver isn't a prediction. It's a mathematical possibility based on historical ratio relationships and current market dynamics. If gold continues its bull market, which seems likely given the macro environment, and if the gold-to-silver ratio normalizes to even moderately historical levels, the math gets you to triple digits pretty quickly. Add in a physical squeeze or a rush of institutional money, and you could see prices that seem absurd from today's perspective but make perfect sense in the context of supply and demand. The question you need to ask yourself is this: what's your exposure to this potential move? Are you positioned to benefit if silver does what the indicators suggest it might? Or are you going to watch from the sidelines and wish you had paid attention when the signals were flashing? Markets don't ring a bell at the bottom. They don't send you an email when a major move is starting. They give you signals, indicators, data points that suggest something is changing. And right now, in silver, those signals are as clear as they've been in years. The hidden indicator has spoken. The gold-to-silver ratio is breaking down. The physical market is tightening. Industrial demand is growing. Monetary demand is increasing. The setup is there. The question is whether you're going to recognize it for what it is, a potential opportunity that doesn't come around very often. This isn't about getting rich quick. This isn't about gambling on price movements. This is about recognizing when fundamentals, technicals, and market structure align in a way that creates asymmetric opportunity. And in silver right now, that alignment is as clear as it gets. The move to $100 might not happen this year. It might not happen next year. But the trajectory is set. The indicators are pointing the way. And the smart money is already positioning. The only question is whether you'll be part of that move or watching it happen from the outside.